A very good morning, friends. So I hope everybody is doing well. And of course, most importantly, I guess you've done your cumulative revision on Index 103. To remind you, we were discussing the concept of acquisition accounting, and we are working on a 7-step model as far as acquisition accounting is concerned. Also, I gave you that when there is a transaction between unrelated parties and it turns out to be an acquisition accounting, then we apply a 7-step model. The first step is identifying the accounting acquirer. Well, I'm not reminding you the parameters of deciding that. We've already dealt that in detail. The second step is getting the acquisition date. And we've seen the differences in terms of date of acquisition and the concept of a closing date. The step number 3 is divided in terms of 2 sub-steps, wherein first we apply the concept of Index 12, considering all those assets and liability where the book value, which is now going to be the fair value, differs from the tax base, resulting in a DTL or a DTA, as the case might be. Then the step number 3B focuses in making a list of all the assets and the liabilities which have been assumed. And of course, the 8 exceptions where I gave you that which items are to be taken at other than a fair value, or which items are not in the balance sheet of the acquiree, but still find a place in the acquisition entry. And out of those 8 items, we are yet to discuss 2 items. One is a share-based payments, which I'm going to do today, and the concept of reacquired rights, which also I'm going to discuss today. So we've got 2 pending issues related to the step number 3B. One is the reacquired rights and one is the share-based payments. Then in terms of the step number 4, we decided the purchase consideration. That's what we are concentrating on. And within the step number 4 also, there are 7 issues. So I think it's easy to remember, because when you're looking at acquisition accounting in overall 7 steps, and within the step number 4 also, there are 7 issues to be taken care of. Now, basically, a purchase consideration is the sum total of the cash which you're going to pay to the shareholders of the acquiree and the fair value of the shares which are going to be issued to the shareholders of the acquiree. But apart from this, I also gave you a list of 7 important agendas, out of which we have already discussed 5. One is the DC, the deferred consideration, where you consider the fair value, the present value of the consideration to be paid in the future. It's going to be paid in the future and is definitely going to be paid. Then there is a contingent consideration which you need to decide is paid in the capacity of the shareholder or the employee. And once you say it is paid in the capacity of the shareholders, we take the fair value as a part of the PC. Wherever the consideration is paid in the capacity of the employee, it is not taken as a part of the PC. Now, the similarity between a DC and a CC is it is going to be paid in the future. But what is the difference between the two? A DC is definitely going to be paid, but a CC is something which may or may not be paid depending upon the conditions attached. If the condition attached is a service condition, it becomes a CCE, paid in the capacity of the employee, not a part of the PC. But if the conditions are other than the service conditions, then it is CCS. And then we went to the 4th concept, that is called a TC, that is a transaction cost which is not taken as a part of the PC. So we did DC, we did CCS, we did CCE, we did TC, and then I exposed you to the concept of PHI, which has got a little knowledge in terms of the financial instrument standard as well. And I give you a simple 3-step model looking at which case is it, and accordingly the gain or loss on the fair value versus the book value of the investment is taken to the P&L or OCI. And then of course the treatment of the accumulated OCI, which is arisen on account of the previous accounting. And that is either to be recycled, then it is taken to the P&L, or it is not recycled, then it is shifted to the retained earnings. So these were the 5 agendas what we have covered. Don't worry, I'm going to make a mind map soon after the 2 agendas. We'll make a complete chart giving you the impact of these 7 issues before the acquisition date, on the acquisition date, and of course, the post-business combination accounting. Now, I'm going to now start with my 6th agenda, which is also connected to the step number 3B, where we were talking in terms of share-based payments. So let me, I think, first start with the agenda of a share-based payments with you. Then we're going to go to the next agenda, that is pre-existing relationship. Sir, is the class today going to be technical? Yes, likely, of course. Our discussions on a share-based payments would start, which might be slightly technical. Then pre-existing relationship would be a little more. And then we have got agenda of doing a comprehensive questions with you. But before that, I might do first a case of reverse acquisition and then do a little comprehensive question. So I think let's begin the journey. That was a little warm-up exercise, giving you a quick recap on things. So let me just see if there is any questions. Otherwise, let's begin the journey forward. So once again, a very good morning, friends, to all of you. And I think let's begin the journey. Okay, now before we start with the agenda issue number 6, I'm now on the step number 4, and I'm looking at the issue number 6, and that is regarding SBP, that is share-based payment awards. Now, first, let's consider the background why we are talking in terms of a share-based payments. I believe you've already done Index 102, so you know the accounting treatment of a share-based payments in connection with the SBP. Now, watch this carefully. Let's first give you the logic. Now, let's imagine there is a company A Limited and there is a company B Limited, and let's say A is the acquirer and B is supposed to be the acquiree. So let me put it out here that A is the acquirer. Let's consider the legal as well as the accounting acquirer, and B is supposed to be the acquiree. Now, let us consider that B Limited is got, let us say, 1,000 shares in the company. So B Limited is got a total number of shares. Let us say he's got a total of 1,000 shares in the company. Now, let's say A gets a control over B, and let's say he acquires to the extent of 60% shares. So he acquires a 60% stake in the company. That means out of 1,000 shares, he gets a control over 600 shares. Well, undoubtedly, the percentage being 60%, he definitely gets a control over B Limited. Now, another addition to this particular facts. Now, let us say B Limited is also issued certain ESOPs to the employee stock option plans. So B Limited is already issued certain ESOPs to the employee, and once these ESOPs are issued, let us say he would land up issuing, let's say, another 300 shares. Once the ESOPs are issued, he will land up issuing another 300 shares to the employees of B Limited. Now, A is quite aware of this fact. Now, please hear this very carefully. So B Limited has also issued certain ESOPs, that is 300 shares, which will be allotted to the employees of B, and A is quite aware of the fact. Now, just imagine, once B Limited is going to issue these 300 shares, you can say the total number of shares is going to be 1,000 plus 300. That makes it a total of 1,300 shares. So once B Limited is going to issue the 300 shares to the employees of B, the total share capital of B is going to work out at 1,300. Now, A makes an assessment that he's got 600 shares in B, and once the total capital becomes 1,300, he calculates that his stake in the company is going to be 600 divided by 1,300, and he takes a percentage and calculates 600 divided by 1,300. It comes to approximately 46% stake. So I think you logically agree to the fact that the ESOPs being converted into ordinary shares of B would definitely dilute the percentage of A. I put it again. So we can say that B is going to issue these 300 shares, and this will mean that the stake of A is definitely going to dilute. From a 60% stake, his stake falls down to 46%. Now, what is the implication? That he is going to lose control. So he is quite aware of this fact at the time of acquisition. A Limited would be quite aware that B, I would now use the technical term, that B is issued certain potential ordinary share. I think let's put it like this, that B has got certain potential ordinary shares, and A is aware that once these potential ordinary shares are issued, converted into ordinary share, the percentage stake of A gets diluted and he's going to lose a control. Marta kya na karta. So what A Limited does, anticipating that there will be a fall in the percentage stake in B, he's going to lose a control over B. He goes to the employees of B today and makes them an offer that I'm going to replace your share-based payments. So considering this particular fact, what A Limited is going to do at this particular stage, A Limited will tell the employees of B. A Limited will tell the employees of B Limited that, okay, let me do something. Let me replace your share-based payment awards. He will say, let me do one thing. Let me replace your share-based payment award. Instead of ESOPs of B, why don't you take ESOPs in my company? Now, once the employees of B are going to consider the ESOPs of A, naturally, the share capital of B will not increase in the future. And therefore, A will be able to maintain a stake of 60% in terms of B. So A is also very keenly interested that let me replace the awards which B employees have been given. So he says, I will give you the ESOPs in my own company. So he plans to issue replacement share-based payment awards. I hope, friends, I am pretty clear with the background that why we are talking in terms of share-based payments. Because if I directly give you the accounting treatment, you would say, why is A going to issue the share-based payment awards to the employees of B? Now, once we know the position that why A is keenly interested in replacement, because he knows his control is going to get diluted in the future. So he's very keenly interested in issuing in rather replacement of these awards. I hope I am pretty clear so far on this agenda, right? Okay, I got a percentage as well. That is pretty correct. Okay. Now, once A replaces these awards, the situations can be divided into a total of 3 categories. I would say the overall situations can be 3 once A decides to do a replacement. Number 1, it could be a case of what we call a mandatory replacement. It could be a case of a mandatory replacement. That means as per the deal. As per the deal, A is on a mandatory basis required to replace the awards of B employee. Or it could be a case of an optional replacement that A has got an option. He decided to replace, but it was completely optional on his part. So one case is that A is mandated to replace. And one case is that A is not mandated, but he still chooses to replace the awards. And the third case is he decides not to replace. So I would say in a particular question, you need to be careful, and there are going to be a 3 permutation combination. So the accounting treatment is going to be different in all these 3 situations. So at the very first instance, you need to identify which situation is it. Is it a replacement which is mandated? Is it a replacement which is done, but it was completely optional on the part of A, or A decided, no, I'm not replacing? Maybe A is mentally prepared that even if the percentage goes down, let's say, for example, A had a, let's say, 90% stake. He had a 900 shares in B. Now, once B issues the shares to the employees, A still has got 900 shares out of 1300. That means still he gets almost 69% stake. So he may be mentally prepared that the percentage will go down, but I'm not interested in replacement of these shares. So A may also decide that no, I am not going to replace. Okay, now once we get this background, now let's see what is going to be the accounting treatment in these three cases. So we are going to begin with the accounting treatment of these three permutations combination. So let's now watch this particular chart. So we can have a total of three permutation combinations, as I said, in terms of a share-based payment awards. The first case is, as we said, a case of mandatory replacement. The first case is a case of a mandatory replacement. No worry, we're going to do some questions also with you. And I guess you might have confronted a question in Ind AS 102 as well on the concept of replacement of awards. There is a particular question in the scope of Ind AS 102 in the study material, which illustrates that in a business combination, if there is a mandatory replacement, how do you tackle that? Okay, the next situation is that this is a case of optional replacement. It is a case of an optional replacement. Now, how would you decide which case is this in the question? That the language of the question will be indicated. And the third case is he decided that there is going to be no replacement in this case. Now, I'm going to first give you what is to be done, and then I'm also going to give you the logic as well. So don't get worried on the logic. I'm going to give you, first of all, the steps to be applied, and then we're going to see the logic also. Why is it being done so? Let's begin with the first one, that is mandatory replacement. To make it easy again, what I've done, I've divided this treatment in terms of a three-step model so that the calculations do not go wrong, and we're very careful in terms of computing this part. So what we're going to do, first of all, we're going to go to the step number one. Watch this very carefully. So what I'm going to do in terms of step number one, we will organize the fair value of the original award. We will organize the fair value of the original award and the replaced award. So we're going to consider the fair value, and this is the fair value to be taken on the date of acquisition. Now you would say, what is that original award? The share-based payments which B gave to its employees earlier is the original award. We call the share-based payments as awards. And the A Limited is planning to replace these awards, so we're going to call them as replaced awards. So in step number one, you just need to organize the fair value, and which will be very clearly given in the question. You just need to read the question carefully and organize the fair value on the date of acquisition for both for the original and the replaced award. That's it. Just organize the data. Then we go to the step number two. And in terms of step number two, we need to calculate what is the portion of the fair value which relates to pre-business combination. In terms of step number two, you need to organize what is the portion which relates to pre-business combination. Now, don't get worried on the logic. Just see what you need to do, then I'll give you the logic as well. Now, the standard very clearly says that for the pre-business combination, take the fair value on the date of acquisition for the original award, what you've already taken in step number one. So you're going to pick up the fair value of the original award, what you've organized in step number one, and take a certain proportion for the same. And take a certain proportion. I'm again cautioning, don't get worried on the logic. I will give you the logic very soon. First, just see what is to be done. The logic is going to come very soon. So we're going to consider the fair value of the original award on the date of acquisition, what you've taken in step number one. And we're going to take a proportion, and the proportion is the vesting period completed. The original award may have a certain vesting period, and we need to watch out that what is the vesting period which has already been completed. That goes in the numerator, and we're going to consider the original vesting period or the total vesting period, whichever is greater. So we're going to consider a proportion that is the vesting period already completed divided by the original vesting period or the total vesting period, whichever is greater. So we'll take a proportion of this, and that relates to pre-business combination. Don't worry on the logic. I am soon going to give you a logic as well. This portion which relates to the pre-business combination is going to be taken as a part of purchase consideration. The portion in step number 2, which is relating to the pre-business combination, is going to be taken as a part of the purchase consideration. And then we go to the step number 3. And then we go to the step number 3. And in terms of step number 3, we're going to calculate the post-business combination portion. So in step number 3, we're going to calculate the post-business combination portion, which is, careful, we're going to consider the fair value on the date of acquisition for the replaced awards, what you have already taken in step number 1. So I'm going to pick up the fair value of the replaced awards on the date of acquisition, and from this I will reduce the figure computed in step number 2. I'll reduce the figure which is computed in terms of step number 2, and the balancing figure represents what relates to the post-business combination, and the portion which relates to the post-business combination, it is going to be accounted under Ind AS 102. It is going to be accounted under Ind AS 102. Sir, we did not understand the logic of this. Well, I already gave you a disclaimer that don't get worried on the logic. I am now going to explain the logic as well. You just need to first of all remember that there is a 3-step. Don't get worried. I'll give you the logic also now. But just remember, it is going to be a 3-step model in terms of identifying the portion which is taken as a part of the purchase consideration and the portion which is going to be accounted under Ind AS 102 that relates to post-business combination. Okay, now with these inputs, let's understand what are we doing and what is the logic in terms of this particular treatment. Okay, so don't get worried on that. I'm now going to take you to the logics as well. Okay, I think Shankara said, sir, enjoying the class on this Sunday, sir. That's wonderful indeed. I'm too enjoying the presence of all of you. Shruti, sir, B will be aware of these replacements and not have any problem with this. Of course. You see, in any case, as far as B is concerned, it is going to be a subsidiary of A. And once it gets under the control of A, then I think A has got the power to direct and decide what it wants to do. So the management of B is in any case going to be under the control of A. So B cannot have any objection in terms of this particular deal. Of course. Okay. Now I think let's understand the logic. Now let's understand the logic. We'll come back to the 3 steps. Let's understand the logic. We'll do practice questions also with you. Now, let me take an example to illustrate this particular concept to you. Just watch this very carefully. You're going to get your logics as well. Now, let's consider there is company A Limited, acquirer, and there is a company B Limited, which is an acquiree. So A is the acquirer and B is supposed to be the acquiree. Now, let's consider the awards which B has given. So B has given share-based payments award with a vesting period, let us say 5 years. So B has given the share-based payment award, let us say for a period of 5 years. And out of this 5 years, let us say the period which is already elapsed is to the extent of 3 years. And the period which is yet to be elapsed is a period of 2 years. So we're looking at the terms of the original awards which B is issued. So he said, I want a 5 years vesting period, 3 years have already elapsed and 2 years is yet to elapse. Now, as we decided that A Limited is interested in making a replacement of these awards, so he approaches the employees of B and tells them that, okay, I want to replace these awards. Now, employees may not be very keen in getting the share-based payment awards of A. Because if you're trying to convince them that, boss, instead of these share-based payments, why don't you take mine? Everybody is apprehensive. So they would say, why should we take your share-based payment award? Let's continue with B. Why should we take your share-based payment award? So A knows that it is going to be difficult to convince the employees of B. So he has to give them some kind of an incentive and tell them that so that they agree. So he says, boss, let's do one thing, that let's reduce your vesting period. Let's reduce your vesting period and let's make it a total of 4 years. I think that's a good incentive for the employees of B. Because A tells the employees of B that I'm going to reduce your vesting period and let's make it a period of 4 years. The employee starts thinking that's a good deal. He says, okay, that means that 3 years have already elapsed. You've already put in 3 years of service. So the remaining 1 year is what you need to still put in. So the employees feel happy that after 2 years, we were supposed to get share-based payments. Now we're going to get share-based payments after 1 year itself. So that would incentivize the employees of B, and A will be able to replace these awards. Makes logical sense. So A would like to make a reduction in the vesting period, and the reduction in the vesting period would incentivize the employees of B to agree to the deal. I guess I'm making logical sense. Now, this is one thing which you need to keep in mind. Now let's see another input as well. Now, when B Limited was doing the accounting, he was following the concept of Ind AS 102. And mind you, I'm talking in terms of equity settled awards. I'm not talking in terms of cash settled awards. So we're looking in terms of equity settled awards. So when B was doing the accounting, he was applying Ind AS 102. And by accounting under Ind AS 102, he would have created an SBP reserve, because every year he would have done the entry, employee benefit expense would have been given a debit, and correspondingly an SBP reserve would have been created. So he would have an SBP reserve appearing in the books of accounts because of Ind AS 102. Now we know that this SBP reserve is a part of the equity of the company. It's not a liability. So when you account for Ind AS 102, the share-based payment reserve, which is created in the books of accounts, is supposed to be an item of equity and not an item of liability. So when A takes over the business, the control of the business of B, he would acquire the assets, he would assume the liabilities, but he's not going to take over the equity of that company. He's not going to take over the equity of that company. So what happens? When he's going to make a replacement of these awards, then he's going to apply Ind AS 103. And when he's going to apply Ind AS 103, Ind AS 103 would also require him to create that SBP reserve as a part of the acquisition accounting, which is logical. Since 3 years is already elapsed and he's not going to take over this SBP reserve as a part of the takeover, Ind AS 103 also requires that you please create an SBP reserve for the period which is already elapsed. So he would also be required to create an SBP reserve in the books of accounts, that is as a part of the acquisition accounting. Now watch this carefully, because this might create a confusion later. So I just want to give you a clarification at this stage. Now, since he is required to create an SBP reserve in the books of accounts. Now look at the journal entry which he is going to pass. Look at the journal entry which A Limited is going to pass as a part of the acquisition accounting. So what he would do, he is going to record the assets at a fair value. He is going to record the liabilities at a fair value. And when I consider the purchase consideration, I will include this SBP reserve. As a part of the purchase consideration so that it appears as a part of the entry. So what I'm going to do, I'm going to consider, because this is relating to the portion which is pre-business combination. So we are going to insert this as a part of the PC. And then later, when you discharge this purchase consideration, we will put an entry PC debit and SBP reserve gets a credit. That is how this SBP reserve will get created in his books of accounts. Sir, once more. Sir, once more, can you please consolidate this inputs once again? Watch this carefully. Well, it is very easy to tell a person on the accounting treatment. The difficulty comes when you start giving him the logic of that accounting treatment, that why is this being done so? So I'm concentrating in terms of telling you, what is the logic in terms of things. So let's do one thing. Let's create an image once again. Now, I'm coming to the basic facts that B had issued a share-based payments to its employee with a vesting period of 5 years. 3 years has already passed and another 2 years is yet to pass. Now, B Limited would be applying the concept of Ind AS 102 and he would be passing an entry year by year. That is, employee benefit expense would be debited and a corresponding SBP reserve is getting created in the books of B. So can I say for the 3 years already elapsed, by virtue of Ind AS 102, he would have an SBP reserve already created in the books of accounts. I can say effectively to the extent of 3 by 5. If you recall the concept of Ind AS 102, you calculate a cumulative expense and then you take a proportion of the cumulative expense 1 by 5 in each year. So you can say almost 3/5 of the fair value would have been accumulated in the SBP reserve, but this is a part of the equity. The SBP reserve is not a liability and it would be appearing as a part of the equity in the financials of B. This is what he's done as per 102. Now let's come to the picture that A decides to make a replacement of these awards and the employees might be resistance in terms of accepting new awards. They would say, what is a good need and why do we take the new awards? So A would understand the psyche of the employees and in order to induce them to go for replacement, he reduces the vesting period. He reduces the vesting period and says, okay, that instead of another 2 years, you put in another 1 year of service and I'm going to give you the share-based payment. So the employees feel motivated and they agree to the concept. Now, since A has already considered that 3 years is already elapsed, he would also be required under Ind AS 103 to correspondingly create an SBP reserve for the period which is already elapsed. Because when he's going to take over the business of B, he's going to assume the assets and the liability, but he's not going to take over the equity of B. So since he's not going to take over the equity of B, he is also required by virtue of 103 to create an SBP reserve in the books of accounts, which is pretty logical. Because if A is going to give a replaced awards, he needs to consider an SBP reserve for the 3 years already elapsed. So what are we going to do? We're going to calculate how much SBP reserve is to be created, and this will be inserted in the journal entry in step number 7. So the purchase consideration gets included with that SBP reserve, and automatically you get an appropriate goodwill or capital reserve as well. Because you have taken over the obligation to replace these awards, and that obligation to replace the awards should be a part of the purchase consideration. So the moment you take this SBP reserve as a part of the PC, your PC increases and representative goodwill or a capital reserve will come in the entry. And then after this entry, what we're going to do, the purchase consideration will be given a debit and the SBP reserve will be given a credit. So that is how the SBP reserve will get created in the books of A for the portion 3 years already elapsed. I guess, friends, I am pretty much clear on the logic so far. Okay, I'm getting a question now. Tanisha, beta, you said in the share-based payments that the acquiree offers, to the employees, is it possible to issue such share-based payments after the acquirer has acquired the business, or does it have to be necessarily before the acquisition? Please tell us. Well, let me tell you that in my discussion of share-based payments, what we're doing, we are looking at the existing share-based payments, which is already issued to the employees. So as on the date of acquisition, these share-based payments award are already present. Now, coming to the situation, what happens in a post-business combination? Does B still have the power to issue the new ESOPs or not? Of course. But you need to understand that once A is going to get a control over B, every action of B which is going to affect A is the decision maker. So we cannot say that I will not allow B to issue further ESOPs to the employee. Though it is my subsidy, but I would take care of the vested interest as well. I would ensure that B doesn't do anything where he loses, where I lose a control over him. So we can say all said and done, B will get the right to take decisions, but ultimate authority is going to be with the parent because he is got a control over B. Right? So in this case, the focus is in terms of the existing share-based payments, which A decides to replace, considering his own vested interest as well. Right? Okay, so I guess I've created an image understanding of a thought process that why the creation of this SBP reserve is relevant in the books of A. Now, the only question what comes to the mind is that what is the amount at which the share-based payments is created? Now, let's go back to the three-step model. So if you notice in step number one, what I've done, I've just organized the fair value of these awards. Now, let me also tell you, the fair value in step number one is not the fair value as per Ind AS 113. Because when you generally use the word fair value under Indian accounting standards, it always gives a reference to 113. But you know that fair value concept under Ind AS 102 is not the fair value as per Ind AS 113. So in this particular case, we're using the word fair value, but this is not a fair value as per the concept of 113. It's going to be computed by a Black-Scholes model, and it's going to be done by a valuer. So in step number one, you just organize the fair value of the original and the replace awards on the date of acquisition. Now, as we said, that 3 years has already elapsed and 1 year is yet to elapse. So you need to consider a proportion which is going to be created as an SBP reserve. So you need to split the pre-business combination and the post-business combination. So when you consider the pre-business combination, you take the fair value of the original award on the acquisition date and you go to consider a proportion. Now, logically, if you ask me, anybody would say, for a time being, let's say he doesn't change the vesting period and the employees have agreed. So you would say, okay, what proportion of the fair value should I create in the books of accounts? I would say it should be 3/5. I would say it is 3/5. So logically, the portion which I'm supposed to create SBP reserve in the books of accounts is going to be vesting period completed upon the original vesting period. But what have we done in this particular case? What have we done in this particular case? We have taken the vesting period completed, which is 3 years in my example. And we are considering the original vesting period, which is 3, or the total vesting period. The total vesting period is 3 plus 1. The original is 5 in the example, and the total vesting period is 3 plus 1, that is 4, whichever is greater. Now you would say that if a company acquirer has reduced the vesting period to 4, why are you asking him to create a proportion 3/5 and not 3/4? Because at the end of the day, if the vesting period is 4 and 3 years have elapsed, let's take it 3/4. Why take it 3/5? Now, there is a very interesting mathematical catch in this particular thing. I don't know whether I should tell you at this stage or not. It might be a little more overburdensome to your minds. Ask me if you want to hear why did the standard setters decide to take the greater of the two. I can give you a logic as well. but that's going to be a little painful in the morning. You want me to give you a logic of why did they decide the greater of the two? Why not 3 by 4? They decided 3 divided by 5 or 4. Original is 5. The total is 4, whichever is greater. So 3/5 of this portion is going to be taken as a part of the 3 business combination. You want me, friends, to give you some inputs on that as well? Yes, sir. Please tell us. Okay, that's great. Then I think let's give you the inputs on that as well. So I need to work out of this and give you some inputs in this particular case. So let's add on. Now we need to understand some mathematical accounting in terms of, what is being done. So just watch this. The total vesting period is 5 years, and we are considering that 3 years is already elapsed and 1 year is yet to elapse. So this is already elapsed and 1 year is yet to elapse. Now please watch this carefully. If it clicks in a second. If it is going to click, it's going to click in a second. This portion is a part of the purchase consideration, and this portion is going to be accounted under Ind AS 102. Now let me say something, friends. Watch this carefully. Look at my analysis carefully. If this is a part of the PC, can I say this will impact the goodwill? Agreed. If this is a part of the PC, it is going to impact the amount of goodwill, because when you're going to take that SBP reserve as a part of the purchase consideration, the balancing figure goodwill or a capital reserve will get impacted. If you're going to consider this in Ind AS 2, this is going to impact the profit and loss account. The P&L will have an impact, because when you go to account under Ind AS 102, every year you're going to put an entry P&L account debit. Employee benefit expense ultimately goes to the P&L. So the employee benefit expense P&L will get a debit. So this portion will go in the P&L. Now watch this. Now, if I consider, let us say 2 situations. If I say I'm going to consider 3/4 here and I'm going to consider 1/4 here. 3/4 means it is 75%. And 1/4 means it is 25%. Let's say since the acquirer reduced the vesting period, I should consider only 4 years. So 3/4 in the pre and 1/4 in the post. 75% gets a hit in the goodwill, 25% gets a hit in the P&L. Now, if you consider 3/5 out here, then it is 60%. And you would consider 2/5 out here, and that is going to be 40%. Now you need to understand the International Accounting Standard Board realized that, the employers, the legal accounting acquirer were up to some kind of, manipulations in life. Now watch this. If you tell them that let's go with the reduced vesting period, the impact on the P&L is 25%. Let's think futuristic in nature. The impact on my profit and loss for my deeds is going to be 25%. And if I say that you take 2/5, the impact is 40%. Is the acquirer incentivized to reduce the vesting period in order to reduce the burden on the P&L? I put it again. Do you think the acquirer is interested in reducing the vesting period to reduce the future impact? If you tell him boss 2/5, he's getting a 40% burden on the P&L. If you say 1/4, then his burden on the P&L is 25. So I think it's a win-win situation for both. You're telling the employees, I'll reduce your vesting period, and then it also reduces the burden on my future profit and loss account. And that's what the acquirers were doing. The intention of reducing the vesting period was also attached to the intention of reducing the burden on the profit and loss account as well. So the International Accounting Standard Board realized this. They said that by reducing the vesting period, he's got malified intentions of reducing the burden on the profit and loss account itself. So they said, boss, if you're interested in reducing the vesting period, it's your choice. I am not telling you to reduce the vesting period. You are reducing the vesting period. It's your choice. But I'm going to consider the original or the total, whichever is higher. So that the burden on your profit and loss account, 3/5 goes in the pre, so the remaining 2/5, 40% is on the P&L. Your reduction in the vesting period cannot be, considered as a reduction on the future P&L. I guess you got your logics. So the International Accounting Standard Board was very convinced to the fact that let me consider the greater of the two, because even if you reduce the vesting period, that's your choice. Your choice cannot mean that your future burdens on the profit and loss account is going to be reduced. So they said, we're going to consider whichever is greater. Now, tomorrow, if you plan to increase the vesting period to 6, then in this particular case, I will take it as 3/6. I guess, friends, you got your logic on why are we considering the greater of the two, right? I hope I am pretty much clear on the logic. Now let's go back. Now let's go back and see. So in a pre-business combination, you took the fair value and you took the proportion, the years completed 3, original is 5, and the total is 4, 3 or 4, whichever is, 4 or 5, whichever is greater. So we can say step number 2 gives you the portion which is going to be a part of the SBP reserve. But at the end of the day, you need to account for the entire fair value of the replaced award. So you've already accounted for the previous portion in step number 2. So what do you need to do? You need to consider the balancing figure for the post. But when you consider a balancing figure, now you need to account for the fair value of the new award, the replaced award. So you're going to consider the fair value of the replaced award minus what you've taken in step number 2. The rest of the portion is going to be accounted under 102. So I guess, friends, I've given you a complete logic as well. Now it's going to be very easy to remember the concept of accounting. You just need to watch out. In step number 1, organize the fair value of the original and the replaced award on acquisition date. That's it. In step number 2, get the portion which I need to insert in PC and create an SBP reserve. And that's going to be a proportion, the fair value of the original award, and the proportion is what we need to consider the vesting period completed in the numerator and the original or total vesting period in the denominator, whichever is greater. And then in step number 3, you need to calculate the portion which is to be accounted under 102 post the business combination. Okay, so I hope, I believe you're all clear with this. And Tanisha tells me, sir, yes, very clear. Thank you. Yes, Nivedal, got it. Wonderful indeed. Okay, so don't worry, we'll do some practical illustrations also with you. And now let's take the journey, because I didn't want to actually, compromise on the quality as well. Therefore, I requested, and the institute has been very kind enough to give us one extra class on this, because I thought I'll just take the concepts in detail and do a little practice also with you. So we added, with the request, this another session was added so we can do an extensive discussions and you will be able to get a larger grip on the concept. Okay. Now, let's go to the next one, that is option replacement. So this is one. Now let's come to the option replacement. Now let me ask you something very logical indeed. If the acquirer is making a replacement even though he is not required to do so, he is making a replacement even though he is not required to do so, then I think he's a good person. And if he's a good person, trust me, in Ind AS, good persons are given a good accounting. There are many places I've seen in the Indian accounting standard that if you are a good company, you are incentivized in terms of a good treatment. A bad person gets a bad treatment, a good person gets a good treatment. So if it is a case of an optional replacement, the standard is very clear. Let's not tell him to do anything in a pre-business combination. If it is supposed to be an optional replacement, then let him create an SBP reserve and a post-business combination. So what we'll do, he will only he will only account for this in a post-business combination period. He's going to apply Ind AS 102 in a post-business combination. So if the acquirer is making a replacement, though he's not required to do the replacement, in this particular case, no impact on the acquisition accounting. There is going to be no impact on the acquisition accounting, and we will tell him that, boss, you are going to account for this fair value of the replaced awards in a post-business combination period itself. Now comes the third one. He says, I will not make a replacement. Now, very logical. If the acquirer says that I'm not going to make any replacement, then those shares will ultimately go to the outsiders, because those shares are going to be given to the employees of that company, and those employees are the outsiders, NCI. And trust me, a similar three-step model will be done, but except there is going to be a slight little change. So what are we going to do in terms of step number one? In terms of the step number one, now there is no replacement, so I cannot organize the fair value of the replaced award. So what I'll do, I will just organize the fair value on the date of acquisition for the original award only. So we're going to consider the fair value on the date of acquisition for the original award only. So you will only see what is the fair value of the original award in step one. Then you go to the step number two. And in step number two, you will calculate the portion which is pre-business combination. But this portion will not be a part of the PC, because I am not required to create an SBB reserve, because I'm not doing a replacement. If I'm not doing a replacement, I am not going to take it as a part of the purchase consideration. Then what? I'll tell you. But first, I will take the fair value on the date of acquisition for the original award, and I'll take the vesting period already completed in the numerator, the same proportion, and divided by the original or the total vesting period, whichever is greater. Sir, can there be a change in the vesting period even if the acquirer does not replace? Yes, he might agree. As a part of the deal, the vesting period might still be changed. He does not agree to replace, but he may still insist after getting a control that please change the vesting period. So we're going to consider the vesting period completed upon original or total, whichever is greater. Now, this portion, which is pre-business combination, is going to be taken as a part of NCI. This is going to be taken as a part of the NCI, because ultimately, this is the shares which will go to the outsiders and they become potential ordinary shares, increasing the value of NCI. So this pre-business combination portion is going to be taken as a part of the NCI itself. And then comes the step number three. And in terms of the step number three, we're going to consider what is related to post-business combination. And the same things will apply. You will take the fair value of the original award and minus the value you've taken in step number two. That is going to be accounted under Ind AS 102. So this portion in step number three is going to be accounted under Ind AS 102. So the moral of the story, let's, I think, consolidate the picture on this. So when you look at the concept of a share-based payment awards, you need to first of all watch out, is it a case of mandatory replacement? Is it a case of an optional replacement? Or is it a case where the acquirer decides, I am not going to replace? If it is a case of a mandatory replacement, you need to apply a three-step model. The step number two decides what is a part of the PC, and the step number three decides what is going to be accounted under 102. If it is a case of an optional replacement, nothing to be taken as a part of the acquisition accounting. He's been a good person and he's replacing even though he is not required to replace. So you're going to consider this only 102. And if he decides not to replace, everything is same as mandatory replacement, except what is there in step number 2 is a part of NCI. Because these shares are now going to go to the outsiders and they become indirectly a potential ordinary share. So here, the step number 2 is a part of PC. Here, it is a part of NCI. Step number 3 here and step number 3 here is going to be accounted under 102. So can you now also give us a chart indicating that in these 3 permutation combinations, what is the impact on the step number 7, that is before, on, and after the business combination? Why not? So let's do one thing before we go to the practical illustrations with you. I think let's also consider the impact of these 3 combinations on my step number 7. Because once I'm done with the discussions, on all the 7 issues, I will give you a consolidated chart as well, indicating the impact of all the 7 agendas on the step number 7, because that would indirectly take care of my step number 7 in advance. So in this particular case, I'm looking at the impact on step 7 before acquisition date, on acquisition date, and after the acquisition date. So let us look at the impact of the share-based payments on the step number 7 entries as well. So in this particular case, we are looking at 3 particular permutation combinations. And let's look at the entries in step number 7 based on this. So we've got 3 permutation combinations. One is a case of mandatory replacement. One is a case of an option replacement. And one is a case of a no replacement. So these are the 3 permutation combinations, what we are looking at. So we're looking at the concept of mandatory, optional, and no replacement. Well, there is nothing to be done in either of these cases before the date of acquisition. Nothing to be done. If it is a mandatory replacement, it is a part of purchase consideration. And later, what you're going to do, you're going to segregate the SBP reserve in the books of accounts. So as a part of the acquisition entry, you consider a certain proportion in step number 2 computed, and that becomes a part of the purchase consideration, and then put the entry PC debit, SBP reserve credit. If it is an optional replacement, nothing to be done. In this particular case, it is a part of NCI in the acquisition entry. So in this case, it's a part of the PC. In this case, it's a part of the NCI. And in this case, nothing to be done. And if you see something common, you're going to do Index 102 here, Index 102 in all the cases. The post-business combination will be accounted under Index 102. The usual accounting of a share-based payment awards will take place. So this is a summary in terms of how the share-based payment awards is going to impact the entries on acquisition accounting and post the business combination. I think we need to do some questions now. Having understood the concept, I think we need to look at the question, see how the language of the question will decide which case is it and what kind of accountings would apply. Okay, let's see if there is any questions coming in between so far. Yes. Navidal, sir, got a clear picture with your crisp explanation. Thank you. Okay, Tanisha, you said, so why will there be an option replacement, since if the acquirer won't replace them, the employees of the acquiree may become the future shareholders and may dilute a stake where there is no more a parent entity right? Well, you said an option replacement. Let me first clarify. When I say an option replacement, it is I am not required, but I still do that. I'll give you an example. It's a bad example, but you'll understand this. I'm not required to give you so much of detailed explanation, but it was optional on my part that I did that. Am I a good man? Yes, I'm a good man. There is a mandate that I need to replace. That is one thing. There is no mandate that I should give you such a large picture in terms of the logics and all, but still I did that. Since I'm a good person, I'm being given good accounting. So in this particular case, replacement is being done. The replacement is being done. So I'm only required to do accounting later. I'm not being overburdened on my accounting on the acquisition date. So you can say in case of option replacement, the acquirer is replacing, but he's replacing out of his free will. Since he is replacing out of the free will without being mandated in the scheme, you are telling him that you're a good person, so you take the burden in the future P&Ls, no impact on acquisition accounting. Right? And when there is no replacement, you can say the acquirer is mentally prepared for a dilution in the future. He says, I don't care. Even if the shares are given to the outsiders at a later date, the NCI will increase, let it be, because my control will still continue. It doesn't bother me. Right? I guess you got your answer, beta Tanisha. Okay, now let's go further. Now let's do some questions with you on this area. I'm going to take you to the study material, and there are some questions which are given in the study material on this area. So let me go to the study material and let's have a look at a few questions with you. Okay, so I think the first question, what we're doing is there is an illustration in the study mat, and that is illustration number 27. So we've got illustration number 27, which is there. Let me just crop this a bit so that you are able to see the complete picture. Okay, let me just zoom it a bit. So this is illustration number 27 in the study material. And I think let's have a look. We're going to decide reading the language as well. I hope the visibility is good. Maybe we could zoom it a bit more. So illustration number 27. So we're on illustration number 27. I guess the visibility is good to go. You can see that. Okay, got with that a good practical example. Indeed, sir, you are an excellent teacher. Thank you. Thank you, Tanisha. Thank you indeed. Okay, so let's, I think, read illustration number 27. Let's look at the facts and decide the kind of situation. Green acquired pollution as a part of the arrangement. Green had to replace. I don't think so. I need to interpret the word he had to replace. But let me still ask you, Basanti tumhara naam kya hai? Basanta. When it says it had to replace, can I say it means it is supposed to be a mandatory replacement? The language of the question is pretty much clear and telling me at the very outset that Green had to replace the pollution's existing equity settled awards. So very, very clearly given to the question, he had to replace as a mandatory replacement. The original awards had a vesting period of 5 years, and at the rate of acquisitions, the employees have already rendered 2 years of service. So out of 5, 2 years have already elapsed. So I am required to create a proportion of this as a SBP reserve in my acquisition accounting. As required, Green replaced the original award with own share-based payment awards, that is called a replacement award. Under the replacement awards, the vesting period is reduced to 2 years from the acquisition date. So he has reduced the vesting period for another 2 years from the acquisition date. So we know that 2 years already elapsed and another 2 years is required. So the total is supposed to be 4. Earlier it was 5, now it stands reduced to 4. The market value of the awards on the acquisition date, original and the replace awards is given. So this indirectly becomes my step number 1, organizing the fair value, the market values of the original and the replace awards on the date of acquisition. And on the acquisition date, all the awards are expected to vest. Determine the accounting for the above replacement award. So step number 1 is already given. I just need to go for step number 2 and step number 3. So let's consider the step number 2. When I'm going to consider the step number 2, what is a part of the purchase consideration? We decide what is a part of the purchase consideration. So what do? We take the fair value of the original award 500. This is the fair value on the date of acquisition into the vesting period completed divided by the original or total vesting period, whichever is greater. Whichever is greater. I don't need a percentage. That'll automatically give me a percentage. So we're going to consider 2 divided by 5 or 4, whichever is greater. So let's consider 2 by 5. 500 into 2 by 5 comes to 200. Then we go to the step number 3, and in terms of the step number 3, you would consider the portion which is going to be accounted under Ind AS 102. The post-business combination is going to be accounted under Ind AS 102. Now, you need to consider the fair value of the replace award. The fair value of the replace award is 600 minus step number 2 is 200. 400 is going to be accounted under Ind AS 102. So I just need to tell the examiner that this 200 is what is a part of the purchase consideration so that I can create an SBP reserve in the books of acquirer, and the rest 400 is going to be accounted under 102 in a post-combination period. So I guess you can keep reading the answer, but let me just show you quickly. So 200 will be considered as pre-combination and will be included in the purchase consideration. And 400 will now be recorded in the remaining vesting period, which is 2 years, as employee compensation cost. So I would say always go for a 3-step model to make your life simple. Organize the fair values, step 1. Get the pre-business combination portion, step 2. And get the post-business combination portion, step number 3. Life jingalala. Okay, so this was simple. I think let's now consider maybe another question with you. Okay, I think the question has got cut. I have deleted a particular thing. Let me do one thing. I'm also carrying a little questions in the assignment as well, which I picked up from the study material. So let me take you there. We can have a look at another question as well. Let's do another question also with you. So let's have a look at another question with you. And this is what I've taken in the assignment. So let's have a look at this question. Let me zoom it a bit further. Yes, I think that's good to go. Okay, so let's, I think, read another question with you. Let's do a little more practice before we go to the next area of discussion, which is reacquired rights. Okay, Shankara understood the concept with the illustration very well. Thanks a lot. Thank you, Shankara. Thank you so much indeed. You're all a beautiful audience, and I think that's makes my efforts also, good, because when you're confronted with a good audience as well, automatically the efforts go in the right direction. Thank you, all of you, indeed. Okay, now let's have a look at another question with you. I guess let's look at question number 19. This is a question which is given in the education material. It says on 1st April, company ABC granted equity settled share-based payments with a fair value on the grant date is 1 lakh to the employee, subject to a 3-year service condition. The company XYZ acquires the entire share on April 16, and as a part of the acquisition, it is required. It is required. I've already put that highlighted word in a red color, telling you that if it is required, you know that this is supposed to be mandatory replacement again. As I said, the language of the question is going to be clear. You must be thinking, so one question on option, no replacement. Nobody. The next one. Then he says, at the date of acquisition, the market value of the original award is given and the market value of the replace award is given. So that makes it step number 1. He's given you the market value of the original award 180 and the market value of the replace award, that is 2 lakh. The replacement awards a 1-year vesting condition. Determine the amount which is attributable to pre-business combination and post-business combination, where all employees are expected to meet the service condition. So I think the step number one is already there. Let's go to the step number two. What is going to be taken as a part of the purchase consideration? So I think let's do the mathematical calculation. What is the fair value of the original award on the date of acquisition? 1,80,000. The vesting period, which is already completed, is how much? There is a 3 years vesting period, and we are sitting on April 16, 2 years already completed. What is the original vesting period? 3. And what is the total vesting period? Well, I think another 1 year. So that means 2 plus 1, 3 remains the same. So we can say 2/3 would mean 1,20,000. So in this case, there was no change in the vesting period. The original was 3, and even the total 2 plus 1 still remains 3. So 2/3 is taken. Then let's go to the step number 3. What is going to be taken as per Ind AS 102? You're going to consider the fair value of the replace award, that is 2 lakh, minus what you've taken in step number 2. So this 80,000 is going to be accounted under Ind AS 102. I think it's pretty simple and straight indeed. Okay, so I think I might have got some answers from your side as well. Yes, we've already got the answer. Wonderful indeed. That is great. Super. Okay, now let's try a last question on this area before we take a discussions to pre-existing relationship. Let's go to the question number 20. It says Green acquired pollution as a part of the replacement and it had to replace. It had to replace. I think you can do this question because when it says it had to replace, then I think it is pretty clear that this is again a case of mandatory replacement. It is a question in the study material and I think you can easily manage it. Okay, I think I've taken a question on another one as well. Let's have a look at this. Let's have a look at question number 21. So this is, I guess, on the concept when he says, I'm not going to replace. Let's see the inputs. It says question number 21, P, a real estate company, acquires Q, another construction company with an existing equity settled share-based payments. The awards will vest after 5 years of service. At the acquisition date, 2 years of service have already been rendered, so 3 years is left. None of the awards are vested at the acquisition date. P did not replace the existing share-based payment. I've already highlighted the word which is going to tell you which particular case is it. So when it clearly says P did not replace, it is a clear-cut case that there is going to be no replacement in this case. If it is a case of no replacement, you're still going to apply a 3-step model. Organizing the fair value of the original award, then step number 2, pre-portion NCI, step number 3, post-portion Ind AS 102. Okay. So let's, I think, have a look. But it says it reduced the remaining vesting period from 3 to 2 years. They reduced the vesting period from 3 to 2. Then he says company P determines that the market value of the award on the acquisition date is 500. Determine the accounting treatment. So let's organize step number 1. So we need to calculate the fair value of the original award, that is 500. Then step number 2, we need to decide what is a part of NCI, because if it does not replace, then in that particular case, this is going to go to the outsiders and is going to become a part of the NCI. So we will take a proportion of 500. What is the vesting period completed? The vesting period completed is 2. Original vesting period is supposed to be 5. And now he's reduced the remaining vesting period from 3 to 2. So total is 4. So we are considering the original vesting period 5 or the total vesting period 2 plus 2, 4. So that makes it 2/5. That is 200 is a part of NCI. Then step number 3, what is a part of Ind AS 102? 500 minus 200 in step number 2, 300 becomes a part of Ind AS 102 accounting. Simple and straight indeed. I'm sure I would have already got your answers as well. Yes, we got the correct answer. Wonderful indeed. So this takes care of my sixth agenda, that is a share-based payment, and the pending agenda related to the step number 3B, where we said share-based payment becomes an exception. So are we considering the share-based payments at a fair value? No, because the fair value concept is not as per 113, and it is based on a market value assessments. Okay. Okay, now with this, I think let's take it further. So I am now going to go a little further with you. I guess we can add a page here. Okay, so now we are coming to another crucial issue as a part of the purchase consideration where you can get independent questions. Like even in terms of share-based payments, you can get independent questions in the exam. One is that you get a larger questions where all these issues are there, and one is that you get independent questions. So I think out of these 7 issues, PHI is one where you can get independent questions, and share-based payments is another where you can get independent questions, and the pre-existing relationship is another. Now watch this carefully. This is going to be a little technical discussion further. So I am now coming to the concept of issue number 7. But I think in the meantime, before we go further, since we've done an extensive discussion of almost around 1 hour and I would say 15 minutes on this area, I want you to give your comfort zone scores on the concept of SBP. Rest what we've done yesterday is done. Now I need to give you need to give yourself a comfort zone on the conceptual understanding of the share-based payment award on a scale of 10. What is your conceptual understanding? Then in the meantime, let me go on to the pre-existing relationship. Shankar sir, is there any question on optional replacement? No, because since an optional replacement will be technically accounted under 102, it becomes more like an independent question on 102. So you don't have any question given out here in the study mat which deals with the concept of an optional replacement. There are only 2 questions, mandatory, or it is a case of no replacement, no option. Okay, we got some good scores coming in, 9.5, then 7, then 10, then 9 and 9. Wow, that's very encouraging indeed. Super. Okay, so I think now let's begin with the issue number 7, the last issue in PC. And we are looking at a pre-existing relationship. We are looking at a pre-existing relationship. Now, this is going to be slightly technical, and don't worry, we'll take questions also to understand this bit as well. Now, the very first question what comes to the mind is, what is a pre-existing relationship? Well, there can be many situations. For example, we can say that before the acquisition date, there was a sale which was made to each other. Acquirer made a sale to the acquiree or vice versa. So they may have a debtor-creditor relationship. So before the acquisition date itself, there is a debtor in one book and a creditor in another book. So they decide that before they go for acquisition accounting, they want to go for a settlement of a pre-existing relationship. So the issue is that there is a pre-existing relationship, and they want to go in for a settlement of this pre-existing relationship before the acquisition date. And you would have got the hint that if you want to go for a settlement before the acquisition date, naturally the entries in step number 7 are going to be impacted before acquisition date. I think let's take a very simple example before we do a technical discussions with you, so that at least you get a flavor in terms of the pre-existing relationship. Let's say there is a company A Limited and there is a company B Limited, and A is the acquirer and B is the acquiree. Now let us say before the acquisition date, prior to the acquisition date. So let us say prior to acquisition date. Prior to the date of acquisition, let's say a couple of months, a couple of years earlier, A made, let's say, a credit purchase from B. So A made a credit purchase of goods from B. So can I say B in its balance sheet would be reflecting a debtor to the extent of, let's say, 10 lakh. and A would be reflecting in its balance sheet a creditor to the extent of 10 lakh. So let's say A, before the acquisition date, a couple of months earlier, made a credit purchase of goods from B. So B in its balance sheet is reflecting that I have to recover 10 lakhs from A, and A is reflecting that, yes, I owe 10 lakhs to B. Now they decide that they want to, settle this intercompany relationship before the acquisition accounting is done. Now, A decides that the purchase consideration is, let's say, to the extent of 250 lakhs. A decides that the purchase consideration for the business of B is going to be a total of 250 lakh. This is including 10 lakhs which he owes them. A decides that what I need to pay for the business of B is a sum total of 250 lakhs, and this is including that 10 lakh rupee which he owes to B Limited for a pre-existing relationship. So if I ask you technically, what is the amount of purchase consideration after settling the pre-existing relationship? I guess you would logically tell me that it is supposed to be 240 lakhs. Let him settle this 10 lakh rupees and then account for the business combination at a 240 lakhs. So what am I going to do? In this particular case, if I were to look at entries, I would say before the date of acquisition, let A put the entry creditors debit and bank gets a credit. And this is to the extent of 10 lakh, settling the pre-existing relationship. You know what you used to do in terms of accounting standard 14 in amalgamation is you used to put an entry creditors debit and debtors credit after the takeover. But here we are looking at that before the acquisition date itself, you decided to go in for a settlement. So in this particular case, what we're going to do before the acquisition date, you pay off this money, settle this creditors. Then on the date of acquisition, when you put the entry assets gets a debit, liabilities gets a credit, and you consider the purchase consideration, you're going to consider the purchase consideration at 240 lakhs, which means the impact is passing an entry for settling the pre-existing relationship, one, and also reducing the purchase consideration. This was a simple example to give you a flavor of how the pre-existing relationships are going to be settled. First, settle the transaction prior to the acquisition date, and then correspondingly reduce the purchase consideration. I know what is going further in your mind. You must be thinking, sir, if this was a transaction where B shows a creditor and A shows a debtor, then in this particular case, are you going to increase the purchase consideration? Yes. In this particular case, I'll first put the entry, bank gets a debit, debtor gets a credit, and the purchase consideration is going to be increased to that extent. So depending upon the purchase consideration has been netted off, because you need to pay them 10 lakhs for an existing relationship and 240 for the acquisition purposes. So we made a reduction in the PC. If this would have been a reverse situation, I would have perhaps increased the PC. Right? I guess the basic flavor is clear. Okay, now we need to do a little more extensive discussion, because Indus 103 gives us a very specific treatment if there is a settlement of a pre-existing relationship. So let me tell you now the inputs. Let's make a chart on the settlement of pre-existing relationship. Settlement of pre-existing relationship. So there is a settlement of a pre-existing relationship. Now let's see what the standard tells us as far as a pre-existing relationship is concerned. At the first instance, I would say there are two cases. When you look at a pre-existing relationship, the standard tells me you need to watch out, is it contractual in nature or is it non-contractual in nature? You need to see that is it contractual in nature or is it non-contractual in nature? So to give you a specific treatment on the concept of a pre-existing relationship, you need to watch out, is it contractual or is it non-contractual? Now, let's consider the example. When I say non-contractual, it could be, for example, a legal case going against each other. Because in this case, there is no contract between the two. So the amount of existing relationship is related to a legal case between the two. So for example, A Limited, which is the acquirer company, and B is the acquiree. Let's say B has put a court case against A. It can be the other way around as well. But let's say B, the acquiree company, has put a court case against A. And this is an existing relationship that B filed a case against A, putting a claim. And A decided by virtue of Ind AS 37. He decided by virtue of Ind AS 37 that it is a contingent liability. So let's say, for example, before the acquisition date, B filed a court case against A, and A, after evaluating the situation under Ind AS 37, decided it is a contingent liability. But now, when the acquisition takes place, they sit down mutually and B tells him, pay me for the court case. You owe me a compensation, so please pay me the money. So what we're going to do in this particular case, what A is going to do in the books of accounts before the acquisition date, he will put the entry profit and loss account debit and the bank gets a credit. He is going to settle the pre-existing relationship. I'm looking at non-contractual. Non-contractual means that there was no contract between the two parties. So B had put a court case against A and he said, it's a contingent liability for me. So he will take the hit in the P&L and make a payment in bank. This will be equal to the fair value of this liability. The examiner will give you the fair value of this liability and he will put the entry P&L debit, bank gets a credit to the extent of fair value. Now, a question might arise in your mind. So instead of a contingent liability, if let's say A has already created a provision in the books of accounts, when A applied the concept of Ind AS 37, he created a provision in the books of accounts. Not a problem. Then you can put the entry provision gets a debit to the extent of book value. The bank gets a credit to the extent of the fair value. And any balancing figure in this particular case is going to be taken in the profit and loss. So the treatment is pretty simple. If there is no provision in the books of accounts, the entire fair value gets a hit in the P&L. If there is already a provision in the books of accounts, then the provision gets a debit to the extent of the book value, bank gets a credit to the extent of fair value, and any difference is the gain or loss which is taken to the P&L. So this is what you need to do before the acquisition date. And if you look at on date of acquisition, what are you going to do? When you're going to consider the purchase consideration, you will decrease the purchase consideration by the fair value. Don't worry, we'll take examples to illustrate it further. But you need to consider in mind that if it is non-contractual, if it is a non-contractual relationship, so I'm considering the cases where B, acquiree might have filed a court case against A. It can be the other way around, but generally you're going to get questions largely on the fact that the acquiree has put a court case against A. So in this particular case, what you need to do, if there is no provision, take a complete hit on the P&L. If there is a provision, only take the balance hit in the P&L, because you're going to put the entry bank with the fair value. P&L gets a debit if there is a provision for the balance. Otherwise, the full debit goes to the P&L. And on the acquisition date, since you made a payment settling a pre-existing relationship, reduce the amount by the fair value. Remember one thing, there is a common mistake which people do. This reduction will always be at the fair value, whether it is this case or it is this case. People tend to get confused. They say that if there is already a provision, will I change, reduce the PC by the fair value? Yes. The payment is in the bank at a fair value. You're recording the payment in both the cases at a fair value. So the reduction in the PC is going to be at a fair value itself. So what do you need to do? You need to put an entry settling the pre-existing relationship before, and then on the date of acquisition, making a reduction or maybe adding the PC, I would say, as the case might be. This is one. Next. The next agenda is if the relationship is contractual in nature. Now, this gets a little complicated, which I am going to explain with the help of an example. Because if it is contractual in nature, let me also tell you, it may give rise to a reacquired asset as well. It may give rise to a reacquired asset as well. So if you remember, I told you that there is a concept in step number 3B called reacquired rights. So if there is a contractual relationship, it may also give rise to a reacquired rights as well. So I think let's not put it as asset, let's put it as reacquired rights. This I'll explain with a question because this can be slightly technical. So let's do one thing. Let us first take an example understanding this example. Then let's go to an example understanding the concept of if it is something which is contractual, how do you calculate a gain or loss settling the pre-existing relationship? And if it gives rise to reacquired rights, what do we do? I think let's go to a question. In the meantime, let me see if there are any questions coming to your mind. So far, so good. Okay. I know this is getting quite technical indeed. As I said, when I started off, that today is going to be a slightly more technical, but trust me, we're already maintained the technical things. Now the level of the standard will slightly going down as we progress, except a little technical on the reverse acquisitions. Okay, so I think let's take an example with you on the concept of reacquired rights. I guess this is a beautiful example on the concept of reacquired rights. Okay, this is illustration number 20. Okay, I think let's take the first example out here itself. So let me go to the illustration number 20 to begin with. Let's go to the illustration number 20. So let me zoom this further. We'll just decide whether it is a case of contractual or non-contractual. Let me just, I think, crop this a bit to zoom it. Okay, so I think first, let's do one thing. I'm going to first read the facts of the case. So we're going to read the facts of the case and then we'll decide. So let's come back. Let's decide the facts of the case. Now, watch this carefully. This is a little technical illustration. Don't worry. After this, we'll give you a break. After this illustration, bear with me for another 10 minutes or so. I'm looking at illustration number 20 in the study material. Let's read. ABC acquires PQR for a consideration of 1 crore. The purchase consideration is given to me. It is 1 crore. Then it says 4 years ago, ABC had granted a 10-year license allowing PQR to operate in Europe. 4 साल पहले, the acquirer company granted a license to the acquiring company when there was no acquirer-acquiree relationship between them. It's a pre-existing relationship. So it says ABC acquires PQR. ABC had granted a 10-year license allowing PQR. When it granted a license, can I say it was a contractual relationship? Because when he granted a license, he would have granted a license on the basis of a contract. So this is contractual in nature. The cost of the license is 2,50,000. The contract allows either party to terminate the franchisee at a cost of unexpired fee plus 20%. Any of the party can terminate the agreement. What do you need to do? When it says that unexpired initial fees would mean the book value of this franchisee right. So this franchisee right was given to the other company. So for the other company, it became an intangible asset under Ind AS 38. I put it again. When ABC gave to PQR the rights, you can say for the company PQR, it became an intangible asset under Ind AS 38. So he would have started amortizing that intangible asset based on the contractual life. Because when you consider the life of the intangible asset under Ind AS 38, generally the life of the intangible asset is based on a contractual life. Since it's got a life of 10 years, PQR would have decided to amortize this license over a period of 10 years. Now, when it says 4 years ago, we can say the license was acquired at a cost of 2,50,000, and we would have decided an amortization of 25,000 per annum, considering a life of 10 years. Since 4 years have already elapsed, a total amortization of 1 lakh rupee must have been taken so far. So we can say in the books of PQR, out of 2,50,000, 1 lakh amortization has already taken place. So I can say the book value of this asset as of today would be 1,50,000. So he says the contract allows either party to terminate the franchisee at unexpired fee. Unexpired fee means the book value plus a 20%. So he gives you the calculation at the date of acquisition. The settlement amount is 180. So anybody can exit out of the contract by making a payment of the book value plus 20%. So 150 plus 20% makes it 1,80,000. So he says they can exit out of the agreement by making a compensation payment, which is to the extent of 1,80,000. Then he says ABC acquired PQR because it sees a high potential in the European market. ABC calculates under the current economic conditions and at the current prices, it could grant a 6-year franchisee at 450. If the acquirer company would have granted this license on the date of acquisition, if the acquirer company would have granted a license on the date of acquisition for the remaining period of 6 years, he would have granted this at a value of 4,50,000. Now, see what the standard talks of. We are given some inputs in terms of things. Let me just read and explain the things. I've already explained the non-contractual part. We're now looking at a contractual part. Now, watch this. The para number B51 of 103 provides that acquirer-acquiree may have a relationship that existed before they contemplated a business combination called a pre-existing relationship. A pre-existing relationship between acquirer-acquiree may be contractual or non-contractual. I've already explained the non-contractual part. We are now looking at both of them. The standard in the Appendix B and para number B52 elaborates the accounting. Now let's see. It says if the business combination is settling a pre-existing relationship, the acquirer recognizes again a loss. If it is a non-contractual relationship, you recognize again a loss equal to the fair value. That's what I gave you. P&L debit, bank gets a credit. So if there is a non-contractual relationship, you recognize the gain or the loss at a fair value. If it is a contractual relationship, you need to consider the lower of the two. Now he's telling me that if there is a settlement of a pre-existing relationship, which is contractual in nature, the gain or loss is equal to the lower of the two. Don't worry, I'll consolidate everything. The amount by which a contract is favorable or unfavorable from the perspective of the acquirer when compared with the current market terms. He says, do one thing. Ask yourself a question. If I would have granted the right as of today, what is the fair value I would have charged? 4,50,000. He said very clearly, ABC calculates under the current conditions and at the current prices. If I give a 6-year franchisee, I would have given it 4,50,000. So you need to calculate the amount by which the contract is good or bad from the point of view of the acquirer. So in this particular case, we can say, if I would have granted the right on the market terms today, I would have given it at 4,50,000. And you need to compare it with the book value of this right. The company which you're acquiring, PQR, has got a book value of this right at 150. So when you're going to acquire this right, you can say the market value of this right is 450. So number one, you need to understand one thing. I gave a right to the acquiree before the acquisition dates. I gave them a license, which was a right given. Now I want to reacquire the right back. As ABC gave a right to PQR earlier, it was a case of a right given. Now what do you need to do? You want to reacquire the right back. It says ABC acquired the company because it sees a good potential. So you gave them a right to operate in a certain market before the relationship. That is before the relationship came. Now you tell him, boss, I want the right back. So at the first instance, you are going to create an intangible asset in the acquisition entry at 450. So when you're going to put an entry of acquisition accounting, you're going to record this reacquired rights at the fair value, which is based on the remaining tenure. You're going to calculate that if this right comes back to me, then what is the fair value based on the current conditions for the remaining tenure of the license. So that is one thing that you're going to capture this 450 as an intangible asset. One. Number two, I'm going to compare the fair value of this right versus the book value. And I know it has been, you can say, unfavorable to the extent of 3 lakh. The right which I give to the person is worth 150 in his books. I gave him at a cheaper value, you can say. Today, the same right is worth 450. So there is indirectly an unfavorable situation for the acquirer. So he says the amount by which the contract is unfavorable from the point of view of the acquirer when compared to market terms. I will say, boss, I gave you a right which is worth 150 in your books. Today, the same right is worth 450. I've given you, at a cheaper value. So this is 3 lakhs is unfavorable from the acquirer's point of view. Then he says the amount of any settlements which is available. Simple words, what do you pay if you want to exit? ABC can tell company PQR, you take a penalty. He's already told me you can pay a penalty of book value plus 20%. So you can pay a penalty of 1,80,000 and you can exit out of the contract. So what is the loss I would recognize? Should I recognize a notional loss which is to the extent of unfavorable terms or the actual amount which I'll pay as a penalty to exit? It is going to be whichever is less. So we're going to recognize a loss to the extent of 1,80,000. So we're going to put an entry profit and loss account debit and the bank gets a credit because you're going to pay this penalty to exit out of this contract. Sir, this is getting very, 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 very technical. This is getting a little more technical and getting above our heads. It is so technical indeed. Don't get worried. I will consolidate the picture as well. So you just need to first understand what you need to do. You need to calculate the unfavorable situations, comparing the book value and the fair value, and also getting the compensation to pay to terminate, get the lower of the two, that becomes a loss. Okay. So what do you need to do in this case? Number one, the reacquired right gets represented as an intangible asset in the acquisition entry. Number two, you are going to put an entry recognizing the compensation paid for termination of this agreement. P&L account debit, bank gets a credit 180. And number three, you're going to make a reduction in the purchase consideration to the extent of that 1.8 lakhs paid. So you need to consolidate everything. First, give us a break and then consolidate this concept of contractual relationship once more. I'm sure there would definitely be a need to do so. Okay, and I think Tanisha, you said, so, but 1.8 lakh is to be received by the acquirer, right? So 30,000 has to be a gain. No, 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 no. This is not the amount of gain. You see, as a company ABC, you gave a right to company PQR. You telling him, boss, give the right back to me. So you need to terminate the agreement and pay him compensation. So as ABC, it says ABC acquires a company PQR 4 years back. ABC granted him a license. And he says that the contract can be cancelled, terminated by either party by paying a book value plus 20. So today ABC goes to PQR and tells him that boss, I want the right back. So PQR tells him that boss, you need to pay me a compensation for exiting. You want to terminate this right, you want to reacquire the right back from me, please pay me money. So I got to pay him 1,80,000 as a compensation in order to, terminate the agreement. So I would, as a part of the PC, would have paid a compensation of 1.8. So when I do my acquisition entry, I need to make a reduction to the extent of 1.8. I'll give you some more nitty-gritties also. I'll consolidate the picture once more once you take a break. I think it's necessary to relax your minds at this stage. So we'll consolidate this issue after the break. And then I'm also going to make a comprehensive chart combining all the 7 issues. Then I think a small little discussion on step number 5 and 6, goodwill and NCI, which is pretty easy. And then step number 7, entries are done. That would take care of our acquisition accounting. So I think let's give you first a break to all of you. Relax your minds, and then we start back. So it's almost around 8:46, so 10, 12 minutes, and we're going to start back again. Relax your minds, friends. You're welcome, Tanisha. So let's take a break, friends. Friends, I guess you've had a relaxation of your minds after technical discussion on pre-existing relationship. So I think let's first consolidate the learnings on the concept of pre-existing relationship. And then we'll come back to this particular illustration and consolidate the learnings and document this as well. So let's begin the journey. Okay, I think Yadu tells me, so could you please give the entries in terms of illustration 20? Yes, I will definitely give you the entries as well. So I think let's first consolidate the picture to you. So I'm just coming back on the agenda. So let's first have a consolidation of the learnings at this stage. So to remind you, we are looking at the issue number 7 in terms of the purchase consideration, step number 4. So when you're calculating the purchase consideration, I'm looking at the issue number 7, and that is the settlement. That is a settlement of a pre-existing relationship. That is a settlement of a pre-existing relationship. Now, what do you need to do on a step-by-step approach? Let's have a look at what you're going to do on a step-by-step basis. I would say when you're looking at a pre-existing relationship settlement, there are going to be two cases. The first thing which you need to watch out in the question is the relationship which is existing is contractual or non-contractual in nature. So you need to see, is the relationship something which is non-contractual? How would I decide that the relationship is non-contractual in relationship? Well, simply, if there is, let's say, a plaintiff defendant kind of a situation, there is a court case between the acquirer and the acquiree, it gives rise to, you can say, a non-contractual relationship. So when you read the facts of the case, you understand that there has been a court case between the two. It's a case of a plaintiff and defendant. It becomes something which is non-contractual. Or we can say the relationship which was existing between them is contractual in nature, which would arise in a situation where you can say that, let's say, for example, the acquirer had granted a right to the acquiree earlier, like we saw in illustration 20, that there was a right which he had given to the acquiree on account of a license. So the moment they enter into a license, there is a contract between the two, and it gives rise to a contractual relationship. So at the first instance, zero down on the fact that what kind of relationship is there, number one. Once you zero down that it is a non-contractual relationship, I would say watch out carefully. So this is like, you can say, step number 1. So are you going to create a 3-step model again? Yes. So the step number 1 is you're going to see the nature of the existing relationship between the two. Then once you identify that it is non-contractual in relationship, you go to the step number 2. Now, I'm considering only one example where the acquiree filed a case against acquirer. If you take the other way around, the accounting treatment will get totally reversed. But I think let's concentrate only one way. The other ways you can just, do a reverse accounting treatment. So let's say the acquiree had filed a court case against the acquirer. So what do you need to do in this particular case? You need to check. You need to check that has the acquirer created any provision? Has he created any provision for the obligation? So we need to see that has he created any provision in the books of accounts for the obligation. I repeat, I am concentrating on only a one direction. The acquiree has filed a court case against acquirer. If you go to consider the other way around, then the treatments will undergo a reverse. So we are concentrating on only one aspect. Check whether the acquirer has created any provision. So when you say he's created a provision or not, the answer would be either a yes or the answer would be either a no. Either he has not created a provision or he's created a provision. So just look at the step number 2 and get your answer. Then you can go to the step number 3 and put your journal entry. And in this particular case, you need to put a journal entry, whether it's a yes or no. So go in a chronological order and you'll not go wrong. See the type of relationship. Then if it is non-contractual, see, has he created any provision for the obligation or not? If you say yes, he has created an obligation, this is an entry to be done before the date of acquisition. Since he has created a provision, debit the provision at a book value, make a payment that is bank at a fair value. So the entry to be done in this particular case is the provision gets a debit at the book value, the payment which is made is done at a fair value, and any balancing figure in this entry goes to the P&L. Whatever is the balancing figure in this entry will be a gain or loss, and it will be taken in the P&L. That's it. Thereafter, also remember that when you take the purchase consideration, reduce the fair value. Reduce the fair value of this liability from the purchase consideration. So what do you need to do? The settlement of the pre-existing relationship, which is non-contractual in ratio, non-contractual in relation, you need to also reduce the fair value of this obligation as a part of the PC. Next, if you said, no, we have not created any provision, you will pass the entry profit and loss debit, and the bank gets a credit, and this will be completely at a fair value. So this is the entry which you're going to do in terms of the before acquisition date. P&L gets a debit and the bank gets a credit for the fair value. And as a part of the PC, you need to reduce the fair value as well. So the same thing will continue here as well. You will reduce the purchase consideration by the fair value of the obligations under both the cases, whether a provision was created or not. So this is one. Second, now coming to the fact that there is a contractual relationship in this particular case, what do you need to do? This was step number 1. Now you need to calculate the gain or loss in this particular case to be taken. So in terms of the step number 2, you need to calculate a gain or loss arising on account of settlement of this contractual relationship. Now, when you calculate a gain or loss, now what do you need to do? You need to consider the lower of the two. You need to consider number 1, what is the book value of this right? What is the book value of this right in the books of acquiree? So when I'm looking at this particular concept, that is contractual relationship, here I'm again assuming that you must have given a right to the acquiree earlier. I'm not looking at the other case. In both my discussions, mind you, I'm looking at a situation which is adverse for the acquiree. I don't want to do extensive permutation combination discussions. Otherwise, we'll spend 3 hours on the pre-existing relationship only. Considering the kind of questions which are given in the study material, they're concentrated on the fact that if it is a non-contractual, acquiree filed a court case against acquirer. If it is contractual in ratio relationship, then the acquirer had granted a right to the acquiree. So my entire focus of discussion is based on the fact that a court case is put in by the acquiree on the acquirer. The contractual relationship is where the acquirer has granted a right to the acquiree. So in this case, I will take the book value of this right in the books of the acquiree, and I will consider the fair value of this right on date of acquisition. I will say, okay, if this right was given at a fair value, then I will say, okay, let me consider the fair value. Rather, first, let me not use the word lower. So what I will do, I will take the difference between the two. Don't worry, I'll come back to illustration 20. So I will say, okay, let me consider the book value of this right in the books of acquiree and let me consider the fair value of this right and get the difference. So you need to consider the lower of the difference. You need to consider the lower of number one, the difference, and you need to consider the penalty which we will pay, penalty to be paid on termination, the penalty to be paid on the termination. So you need to calculate the two things. You need to calculate the two things. You need to consider the difference between the fair value and the book value, one. You need to consider the penalty you'll pay to terminate the particular right. You need to consider the lower of the two. That's the gain or the loss. Rather, it would be a loss in the given situation. So you need to see that what is the unfavorable part on my part, and you need to see what is the penalty which is paid to terminate, and you're going to consider the lower of the two. Then you go to the step number 3. And in terms of step number 3, we need to put journal entry. Now, when you go to put journal entries, there are a couple of things which I need to do. So I think let me just take it on the next page. So there are going to be a couple of things what you're going to do in terms of the journal entry. You can say before, and you can say on the date of acquisition, and you can say after the date of acquisition. Now, what do you need to do before the date of acquisition? You're paying a penalty. So the entry is profit and loss debit, and the bank gets a credit. This is to the extent of the lower of the two computed earlier. So whatever is the lower of the two, generally you would see it would be the penalty amount. So you have to pay a penalty. So you're going to record the entry P&L debit and bank gets a credit. Typically, you can say the penalty. Now, on the date of acquisition, there are two things to be done. On the date of acquisition, as a part of the acquisition entry, there are two things to be done. As a part of the acquisition entry, you are going to record the reacquired rights. You're going to record the reacquired rights at fair value. So as a part of the acquisition entry in the list of the net assets, since that right is coming back to you, you need to record the reacquired rights at a fair value. One. Second, what you need to do, you need to reduce the purchase consideration by the lower of the amount computed above. So you need to reduce the PC as well. So whatever amount is paid as a penalty will be reduced from the purchase consideration, and the reacquired rights will be done. And nothing is to be done post-acquisition. Now, I will take you back to the illustration number 20, but let's first understand this contractual relationship once again. Now, let's get some logics in terms of things. Now, let's see. Now let's, I think, understand the logic first of all. Now hear my story. You will get the logics. Then I'll go to illustration 20. Now let's say a couple of years back granted a right to the acquiree B. A couple of years back granted a right to the acquiree. Now A knows that if I want to get that right back, I need to basically pay a penalty to get this right back. Because you entered into a contractual relationship with the other fellow, telling him that, boss, I give you this particular right. Now you want to snatch that right away, so you need to naturally pay a penalty. So let's concentrate only on the penalty part. So what I need to do basically, you can say for simple understanding, you got to pay a penalty. So when you're going to pay a penalty, so you need to put an entry profit and loss debit, and bank gets a credit to exit out of that contract. So that is one thing which you need to appreciate, that you are going to pay a penalty. Let's not consider lower of the two. Let's consider you pay a penalty. So you tell the acquiring company, boss, I gave you a right today. I want it back. He says, boss, if you want it back, pay me a penalty to exit out of the contract. So I pay him a penalty, and this penalty paid is reduced from the PC. One. Second, since I'm going to get that right back from him, it becomes a part of my acquisition accounting entry as well. So when I'm going to put the acquisition entry, I will also record that reacquired rights at a fair value. So simply speaking, you can say you pay a penalty, that is one. You put an entry for the payment of penalty before acquisition date. And then you reduce the PC for the penalty paid, because the PC is paid including penalty, so reduce the penalty paid. And you record the reacquired rights as a part of the acquisition entry, the assets taken. Now, the only concern left over is that why are we considering the lower of the two and why not just the penalty? The thing is that when you're calculating the gain or loss, I would say the gain or loss is going to be in terms of two things. One is what you pay and exit. And one is you're comparing indirectly the notional loss. If you technically ask me, when you say this is the fair value of this right and this is the book value of this right, you are indirectly trying to calculate what is the notional loss on account of giving that right to the other fellow. So I am calculating that this is like a notional loss and this is like the actual loss, which is the penalty paid. You need to book the lower of the two. So the standard requires you that if your notional loss is going to be lesser, then you can book only the lesser amount because the penalty paid is not the loss because you got the right back. So the standard setters decided that you should not only look at a penalty. If your notional loss is more, my actual loss is only the penalty paid. But if the notional loss is less, why should be I asked to, technically reduce book a loss to the penalty paid? Since I know that the fair value and the book value difference is lesser, I'll book a loss to that extent. Though I have not seen any question on the area where the difference in the book value, fair value is lesser as compared to the penalty. I hope now you got the inputs in terms of the things. Okay, now let's go to the illustration 20 to understand this better. Okay, Viraj, so what do you do for a relaxation of mind in the break? Oh my God, that's a very interesting question. Well, I did nothing except, I just relaxed my mind and I just had my breakfast at that time. Okay, Tanisha, so please tell what has been written before right in the books of acquiring. I've written book value of this right. The book value of this right in the books of the acquiring. Okay, so I think let's take it further. So the acquirer you said would pay 1.8 lakh instead of 4.5. So there is a loss to be considered. Oh, no worry. I am now going to come back to the illustration 20 to give you this larger concept as well. So I think let's do one thing. Let's now come back to this illustration. And I guess let me give you the entries, everything. Let's read it once again to get a clearer understanding of the picture. So let me just, I think, clear this bit. Then we're going to see the entries, everything in this case. I guess now I can zoom it a bit further so that we can have a good understanding. So let's clear this out. Yes. Now I think, let me just come back. Now let's concentrate completely on this particular illustration. You're going to get the complete picture now. So let me go back to the illustration and read the inputs. It says ABC acquires PQR for a consideration of 1 crore. This 1 crore paid would also include the penalty for termination of the earlier agreement. Correct. 4 years ago, ABC granted a 10-year license to operate in Europe. ABC gave PQR a license 4 years back where he gets a right to operate in Europe for a period of 10 years. The cost of that license was 250, so PQR must have recorded an intangible asset under Ind AS 38 at 250. I repeat. If I look at the books of PQR, he would have capitalized this as an intangible asset and he would have amortized it based on the contractual life for a period of 4 years so far. So we can say the book value of this right in the books of PQR today is 1.5. He took that right from ABC, capitalized it as per Ind AS 38, amortized it on the basis of the life, and the book value today is 1.5. The contract allows either party to terminate this agreement at a cost which is unexpired fee. When I say unexpired fee, it basically means book value. because what is expired is amortized, what is unexpired is the remaining book value, plus a 20%. So he says on the date of acquisition, the settlement amount is 1,80,000. So I think let's concentrate on this, that I, as an acquirer, paid a consideration of 1 crore, including that 1,80,000, which is a settlement amount. So you can say the consideration paid for the business other than pre-existing relationship is 1 crore minus 1.8 lakh. That comes to 98.2 lakhs. So when you make your entry for acquisition, the PC would be 98.2. Let's read further. ABC acquired PQR because he sees a huge potential in European market and he wishes to exploit it. He calculates under the current economic conditions and at the current prices that if a 6-year franchisee is given, it is worth 450. I gave a right to the acquiring company. Now I am getting the right back. So it becomes a reacquired right for me. And if it becomes a reacquired rights, I'm also going to recognize it as a part of the acquisition entry. So he says, how would the license be accounted for as a part of the business combination? Now let's do one thing. Let us, I think, do some basic common sense and put entry. Can I say if I look at before the acquisition date, I paid a penalty. I means ABC. ABC agreed on a settlement amount of 1.8 lakh. So what do? We put the entry profit and loss account debit and the bank gets a credit. So he paid 1.8 lakhs as a compensation. He said, I pay you this 1.8 lakh and I'm going to cancel the agreement with you. So this is the penalty paid to terminate and this is the entry done before. Then we come to after acquisition date. We come to on the acquisition date. Now, on the acquisition date, what am I supposed to do? As a part of the asset, we take the reacquired rights debit. This is going to be taken at 4.5 lakhs. So as a part of the acquisition entry, you're going to take the reacquired rights because I give that right to the acquiree. I've now taken it back. I paid this penalty to get the right back. So I recorded the penalty paid. I got the right back. So I'm putting it as a part of my entry. And when it comes to the purchase consideration, out of that 100 crores, that is 1 crore 100 lakhs, you got to reduce the penalty paid. So what have we done? We've taken the entry for the penalty payment, 1. We've taken the reacquired asset back in the books of accounts, 2. And we've reduced the PC to the extent of penalty. Simple and straight. It is only that when we were calculating the amount of gain or loss, we wanted to compute, number 1, the difference between the fair value and the book value. It's like thinking, oh my God, I gave you a right which is worth 4.5 and it is appearing in the books of accounts at 1.5. I have suffered a notional loss of 3 lakh. It is like comparing what you gave to the other fellow and what is the notional loss. I gave you a right which is worth 4.5 today and it is in the books of accounts at 1.5, notional loss. And the penalty paid is 1.8. So I'm going to consider the notional loss or the actual loss, whichever is less. So we put this entry with 1.8 and then reduce the PC by that 1.8. I hope, friends, I am now absolutely clear on illustration 20, including the impacts of the journal entry. Let me see if there's any questions coming in so far. Are we pretty clear, friends, at this stage on the reacquired rights along with the gain or loss on contractual, non-contractual relationship? Okay, now with this particular understanding, I need to now make a chart, giving you a permutation combinations of all the inputs which I've given you. My step number 4 is done. And I think before I take you to the step number 5 and 6, which is pretty easy, what I'm going to do, I'm going to give you a consolidated chart so that you're very clear now on the concept of these 7 issues, the impacts on the step number 7. So let's begin the journey. So indirectly, I am now going to give you, you can say, the step number 7 itself. So indirectly, I'm going to give you the step number 7 impact. So let's do one thing. Let's indirectly give you the impact of the 7th step as far as all the 7 issues are concerned. Okay, I think I've got a question. Tanisha, you said, so but the penalty amount is only 30,000 and not 1.8. Since 1.8 is composed of 1.5 of the asset we acquired and 30 is the actual penalty. So why have you taken a total of 1.8? Well, the actual outflow is 1.8. 1.5 is not the value in the books of acquirer. It is a value in the books of the acquiree. So these entries are what you're passing in the books of the acquirer. The acquirer is saying that I pay you 1.5. That's my outflow. So I would put the entry for the outflow penalty and changing the PC by 1.8. Then I want to bring the asset back in the books of accounts, not at a book value, but at a fair value. So what we are doing from the accounting perspective, I paid a penalty, I put the entry for the penalty paid. I got the right back, I'm recording the right at the fair value of the asset on the acquisition date. Right? I guess, Peter, you got your answer on that. Okay, so now let's, I think, quickly do a mind mapping exercise with you. And this is going to be crucial but this will definitely help you very much indeed before the exams when you'll be able to consolidate the picture. Because these kind of short charts and steps is going to be very helpful last minute when you do your revisions on things. Okay, so let's create a chart now on step number 4, basically on step number 7. So I'm just quickly taking a recap in terms of the issues, then before, then on, and then after the date of acquisition. So we're looking at the impact of issues in step number 4. Issues in step 4 on journal entry in step 7. So I would put it like this, that this is the impact of issues in step number 4 on the journal entry. You're welcome, Tanisha. So I'm looking at the impact of the issues in step number 4 on the journal entry in step number 7. So we're looking at before date of acquisition. We're looking at on date of acquisition. And we're looking at after date of acquisition. And we're looking at the issues. So let's make a list of the issues. So we've got number 1, DC. We've got number 2, CCS. We've got number 3, CCE. We've got number 4, TC. We've got number 5, PHI. We've got number 6, SBP. And we've got number 7, that is pre-existing relationship. Pre-existing relationship. Trust me, once you're done with this chart, you are going to get a good grip in terms of doing a comprehensive question as well. I think let me on the safe side draw some lines in between as well so that there is no overlapping of the things. So let me just quickly draw some lines in between. So these are the 7 agendas which we're going to confront in terms of the purchase consideration. So let's have a look at these things. Now, I'm going to fill up this particular chart. You just need to keep thinking, try to answer the questions as I progress. If you're able to answer these questions, life jingalala. Okay, let's begin the journey. When it comes to a deferred consideration, there is no impact before the date of acquisition. Is it taken as a part of the PC? Yes. We take it as a part of the purchase consideration, which is at a fair value, which is nothing but it is the present value of the payment. It is supposed to be the present value of the future payment, and you take it as a part of the PC. What you do post-acquisition is the concept of unwinding of discount. What you do in terms of post-acquisition is the concept of unwinding of discount, attributing a finance charge. So these are going to be useful if you get a comprehensive question only on a particular issue. When you look at CCS, contingent consideration, no impact before the date of acquisition. What do you do on the date of acquisition? It's again taken as a part of purchase consideration, and this is again taken at a fair value. What do you do on a post-acquisition combination is it depends upon the form of that consideration. If the form of the consideration is cash or it is variable equity shares, if it is cash or variable equity shares, remeasurements changes in fair value. So you need to capture, you need to record fair value changes. You need to record the fair value changes of that financial liability and put it in the profit and loss. So this fair value changes will be taken in the P&L. And if it is a fixed number of equity shares, then there is nothing to be done in a post-acquisition period. So this is what we've seen in terms of CCS. Then CCE, nothing before the date of acquisition. And also it is not a part of PC. It is not a part of the purchase consideration. So what do you need to do? You need to basically go in for Ind AS 102 application. So normal accounting under Ind AS 102 would apply in a post-business combination accounting. Next. As far as the concept of PC is concerned, nothing before acquisition date, and it is simply charged to the profit and loss P&L debit, and bank gets a credit. This is as far as the transaction cost is concerned. So it's not a part of the PC, but it is directly debited to the P&L. Anything to be done post acquisition? No. Okay, then we come to the concept of PHI. So in terms of PHI, you need to be careful that yes, it could be a case of passive investment or a significant influence. So if it is a case of passive investment, you were under Ind AS 109. If it was a case of a significant influence, you were under Ind AS 28. If you were under Ind AS 109, the gain or loss will be taken in the P&L or the OCI. And if it is Ind AS 28, the gain or loss is going to be taken in the P&L. And apart from this, you need to do further, the accumulated OCI balances have to be scrutinized. So apart from the revaluation gain, comparing the book value and the fair value, which enters the P&L or the OCI, you need to consider if it is a case of Ind AS 109, if it is a case of Ind AS 109, the accumulated balances goes to RE. If it is a case of Ind AS 28, it's going to be taken in the retained earnings or the profit and loss, depending recycling or no recycling. Your mind needs to be very sharp in terms of thinking what is to be done. So you got to consider the amount in RE for the portion which is NR and the P&L, the portion which is R. Here the entire portion is MR. Okay, is there anything to be done on the date of acquisition? Well, the PHI is a part of PC. The previously held interest is a part of PC at a fair value. Then nothing is to be done subsequently. Okay, then it comes to the concept of a share-based payments, and in terms of share-based payments, nothing before the acquisition date. What is to be done on the date of acquisition? Well, in this space, it depends whether it is a case of mandatory or whether it is a case of optional replacement or whether it is a case of no replacement. Accordingly, the treatments are done. So if it is mandatory, you take a pro rata amount as a part of the PC. It is optional, nothing is taken in the PC. And if it is no replacement, a pro rata amount is taken as a part of the NCI. So your mind needs to be clear what is the proportion. So mandatory, you take the proportionate amount PC, no replacement, a portion of NCI, optional, nothing to be done. Then thereafter, you can say, if you're looking at all these cases, If you're looking at all these cases, then you got to apply Ind AS 102 on a post-business combination. कभी कभी मेरे दिल में ख्याल आता है that, if you get a comprehensive question on Ind AS 103, life can become jingalala, where you can get all these impacts into a single packed kind of a question. But trust me, there has been one question which came in the RTP, and that's a pretty long and a good question. You must try that question out. That particular question is containing everything. I think it's there in the study material as well, if I rightly remember. And that particular question contains, beautiful points on everything. The main focus in that RTP question is on step number 3A and B, because there are a lot of agendas relating to step number 3B exceptions in that question. And it is a beautiful question indeed. Okay, now coming to the pre-existing relationship, we can say here the treatment depends upon whether it is a case of a non-contractual relationship or it is a case of a contractual relationship. And accordingly, we put the entry provision, or we can say the P&L debit and bank gets a credit if it is non-contractual. And if it is contractual, the entry is P&L debit and bank gets a credit. So this is what you need to do in terms of contractual and non-contractual. On the date of acquisition, if it is non-contractual, on the date of acquisition, if it is non-contractual, you reduce PC. You reduce the PC by the fair value. And if it is contractual in relationship, if it is contractual in relationship, you definitely reduce the PC. You reduce the PC and you also record reacquired rights. You also record the reacquired rights as a part of the entry, and nothing is to be done post-business combination. So this was a summary of our entire discussions. Practically, you can say the previous class and the current class, I have tried to consolidate this all in a single mind mapping, giving you a crux of all the permutation combinations which can happen. You can maybe, do a little more inputs to this particular chart and make it more beautiful as per your needs. Okay, so I hope you've all taken a note of this. Though, of course, the PDF will be shared to you on the app as well. So now I think let's take it further. Okay, so I think, okay, the answers were coming in. And Tanisha said, so could you please show us the question on the screen for reference? Okay, you want me to show you the question? I think let's keep this for a minute. And then you want to look at the question as well. That was the question. That was the question, illustration number 20. No worry, the PDF will of course be shared to you. So you'll be shared the PDF as well. So this is the summary of the chart. Step number 4 is done. Now let's go to the step number 5 and the step number 6 as well. So let me now take you to the step number 5, which is NCI, and the step number 6, which is goodwill. Okay, so let's go further. So I am now coming to the next step in my acquisition accounting, and that is step number 5. Now, in terms of the step number 5, we are looking at the calculation of the NCI. Now, if you ask me, Ind AS 103 tells me that NCI can be taken at 2 alternative values. The company has got a choice of an accounting policy where they can take the NCI either at a fair value or it may be taken at a proportionate share in the net assets of the company. So we can say when you're looking at the NCI in terms of step number 6, the standard gives you a choice of considering NCI either at a fair value or what is called proportionate share in the net assets. That is what you call sometimes PASNA. So either we consider the fair valuation of the NCI or the proportionate share in net assets. Now let's see. If you were to consider at a fair value, then what do you do? And if it is PASNA? You would say that if nothing is given, what do we do? Well, the question will always tell you directly, indirectly, that NCI is taken at what value. If it is to be taken at a fair value, what we'll do, we'll take the number of shares which are Equity company shares, the number of shares in Equity held by, which is held by NCI. So look at the number of shares in the balance sheet of the Equity, see what is the number of shares held by NCI into the fair value per share. So the examiner would give you the fair value per share of the Equity company, then this technique is possible. If you say Pasna, then what I will do, I will take the net assets, what you've computed in step number 3B. I will take the net assets, what you've computed in terms of step number 3B, and multiply this with the percentage held by NCI. So we will multiply this with the percentage which is held by NCI. Of course, the answer under both the methods is going to be different. The answer which you're going to get on a fair value or on the base of Pasna are going to be totally different in nature. So depending upon the data, you need to apply the two of either of them. Now, let's go to the next step, and that is the step number 6. And that is step number 6, calculating the goodwill, or what we call bargain purchase gain, BPG. It's called bargain purchase gain. In simple words, it is called a capital reserve, but technically we give it a name called a bargain purchase gain. Simple mathematical calculations that when you calculate a goodwill, what do you do? Now, let's have a look at how you're going to calculate the goodwill or the bargain purchase gain. You need to consider the purchase consideration computed in step number 4. It's just a simple arrangement of data. You've already calculated a purchase consideration in step number 4, and to this you add the NCI. And this will be based on the step number 5, Pasna or fair value, as the case might be. And then you add this up and you compare this with the net assets, which you've computed in step number 3B. So all the data is already there with you. You just need to organize the information. The PC represents, for example, 70%, including PHI. NCI is 30%, so this is like 100%. Compare it with the net assets and you get the difference. So let's say if I take this as X and I take this as Y. If your X is greater than Y, you're going to get a difference as goodwill. If the X is less than Y, the difference is going to be capital reserve, called a bargain purchase gain. Sorry. So basically, when you're going to calculate a goodwill or a bargain purchase gain, it's going to be a mathematical calculations. Now, friends, it is important to tell you something. Do you know the concept of a full goodwill and a partial goodwill? Do I need to tell you, or have you already done that in Index 36? That depending upon the calculations of the NCI, you get a full or a partial goodwill, and accordingly the impairment testing is impacted. Do I need to tell you that, or you're already aware of this concept? Do let me know. Okay, Tanisha, so thanks a lot, sir, for such a wonderful 100-page in one chart summary. This is really helpful indeed. Thank you so much, Bida. Thank you so much indeed. Okay, you said, so pardon me, sir, I actually wanted to see that RTP comprehensive question. If you could please show that. Okay, I'll just show you that. And Shruti, sir, can we do some consolidated question? I'll be doing that consolidated question also. Of course, I'll be doing that in the next class with you. And Mansha said, transformational teaching style. Thank you. Thank you indeed, friends. You've made my day. I think, doing things on an early morning on a weekend and with such commendable audience, wonderful audience, and, they appreciate your efforts. You make my day indeed. Thank you so much indeed. Okay, I think I'll show you that question as well. Rather, I'll keep that question in the PDF as well. I'll just show you what question is that which came in the RTPs. Yes, here it is. It is, yeah, this is a question which came in RTP November 2019. It came in the RTP in November 2019 and also came in the MTP March 2019. I'm going to keep that question out here. I'll retain it as a part of the PDF. You must try that question out, though I don't think so. I'm doing that question with you because if I'm going to do this question, it takes almost around, 1 hour 15 to 1.5 hours to do this question. I've got a lot of things more to do in the next class. I need to do a reverse acquisition. I need to do a common control transactions as well. So I think I'm not going to take that constructive obligation in terms of doing this question, but you can refer the RTP November 2019. Okay. Now, let me just come back and, okay, you were telling me, friends, on the concept of partial and the concept of full goodwill. Are you aware of that concept? Otherwise, I need to give you some insights. So are you aware of the concept of a partial goodwill as well as a full goodwill? Otherwise, I'll quickly give you some insights on that. So do let me know. In any case, I think I'll just do a little quick inputs on the partial and full goodwill. Sure. Okay. So let me begin the journey. And let me also give you this because we're going to need that when we come to the consolidation standards. So I think let's give you some inputs. When you calculate your NCI, we've already said that the NCI can be computed. The NCI can be computed either using a fair value or it is using proportionate share in net assets. I'll be coming to this discussion later again in detail when I come to the consolidation standards, but for the time being, when you were to consider NCI at a fair value, it will lead to what we call a full goodwill. And when you go to calculate the NCI at PASNA, it will lead to the concept of what is called a partial goodwill. Now, why is it called a full and a partial goodwill? I'll take an example to illustrate this. Though what I'm doing in this example may not be technically correct, but I think just to give you a basic understanding, let's have a look. I'm going to give you a total of 2-3 situations to understand the concept. So let's see us watch this very carefully. I'm going to show you the goodwill calculations in a few permutations combination. Let's consider the calculation of the goodwill. So I'll take PC, add the NCI, and once you add the NCI, you compare it with the net assets, and you're going to get the goodwill or the bargain purchase gain. So let's see the calculations in this case. So I'm looking at the calculation of the goodwill under few permutations combination. Watch this carefully. Let's say A acquired in case of B 80% shares, and let's say the purchase consideration is to the extent of, let's say, 200 crores. So let's say A acquired 80% shares and the purchase consideration is 200 crores. Alternatively, let's also consider A acquired 100% shares in B and the purchase consideration is 250 crores. So I'm going to take two cases. A got an 80% stake in B with a PC 200 crores. A got a 100% stake in B with a PC 250 crores. And let's consider the net assets of B at fair value. Let's say this is to the extent of 160 crores. So let's say the net assets of B at a fair value is to the extent of 160 crore. Now watch the maths and enjoy. I'm going to first of all consider that if A gets in B 100% stake, A gets in B 100% stake, and I am considering the NCI at a fair value. I'm going to consider the NCI at a fair value. So, but there will be no NCI. I know. If A gets 100% stake in B, there is no NCI, but I'm just maintaining that I'm taking NCI fair value. And let's take a case where A acquires in B 80% stake and I'm considering NCI at a fair value. So I'm considering A gets 100% stake in B, A gets 80% stake in B, NCI is at a fair value. What's this? What is the purchase consideration? 250 crores. What is the NCI? Zero. So this total is 250. And what is the net assets? 160. So what is the difference? Goodwill 90. Simple and straight maths. You took the PC, add the NCI, compare it with the net assets, you got a goodwill 90. Now let's go to the next one. A got an 80% stake. So he paid a PC 200 crores. What is the NCI? Well, I think if the total business value is 250 crores and 20% belongs to the NCI, so 250 into 20% is 50. And this works out at 250 and this is 160 and the goodwill is 90. Can you see that the goodwill is 90 in both the cases, whether it is 100% or whether it is 80% stake? Trust me, even if you calculate with a 60% stake, you will get a goodwill 90. Because at the end of the day, you are comparing not only what the parent paid, but also the NCI. So you're comparing the full consideration with the full net assets, and therefore you're getting a full goodwill. I repeat, you're comparing the sum total of what the parent paid and the NCI paid. So you're considering a full consideration against full net assets, and you're getting a full goodwill. So when we consider the concept of NCI at a fair value, we always get a full goodwill. What does the full goodwill mean? It means the goodwill pertaining to the parent company and the NCI both. It means that this is the goodwill which is relating to both the parent and the NCI. Now let's see alternatively. A acquired 80% stake in B, and let's consider the NCI at Pasna. Let's consider the NCI at a Pasna and let's see the status of the goodwill. Now, in this particular case, A paid 200 crores. And when you take the NCI, we will say NCI is 160 crores is the total net assets. 20% belongs. 20% belongs to the NCI. So out of 160, 32, that is 20% belongs to NCI. You compare 232 versus 160, and that works out at 72 crores. By the way, 72 crores is supposed to be 80% of 90 crores. So in this particular case, you are getting a goodwill which is partial, because you are comparing practically what you paid as a parent versus your share in the net assets. Because by taking this NCI and 160, you're taking only your share in the net assets. So you are comparing what you paid for 80% and what is the share in that 80%, and you get only your goodwill, parent's goodwill. And therefore, when you take NCI at Pasna, we get a partial goodwill. Though the standard clearly gives you a choice. The standard clearly gives you a choice and tells you that you need to consider NCI at a fair value or Pasna. You've got a complete choice. So remember, when a company considers a goodwill, NCI at a fair value, you get a full goodwill relating to the parent and NCI. When you consider NCI at Pasna, you get a goodwill which is partial, which is only the parent company share. This is going to be a deciding factor, especially when you're going to do the impairment testing, and in terms of consolidation, that goodwill impairment loss will be borne by which company, that is the parent or the parent NCI both, is going to be a deciding factor. Right. Okay, I think Manoj says, so your way of style is very easy way to explain to students like us, and it is very fruitful class. Thank you so much, Manoj. Thank you so much indeed. And Tanisha, so we would be pleased if you could give us some insights on it. Okay, you mean to say that question? We'll see if you get time because I have a lot of agendas. I've already taken one extra class because we were scheduled to do it in 4, but I made it almost 5. That's almost like a 25% increase. And I think we need to, some way or the other, condense and try to finish things on a timely basis. And only 80% of 90 crores goodwill, right? Yes, that is correct. And he said, in any case, when A has got 80% stake in B, either NCI is at a fair value or PASNA, the goodwill eligible for A is 72 crores. Correct. So if you say that out of this 90, 72 crore relates to A and 18 crore relates to NCI, absolutely correct. Absolutely correct. Okay. Now, the step number 5 and 6 is done. Now for formality, just a step number 7, a little inputs before we are done for the day. So let's go to the step number 7, a mere formality. Though I've already given you the insights, you very well know the entries before and after the date of acquisition. I am just focusing on the journal entry, which is done on date of acquisition. Because I've already given you the entry, but I think I just want to give you a little consolidation of that entry so that we're very clear with the basic entry. You're going to put the entry assets gets a debit at a fair value. Liabilities gets a credit at a fair value. And you're going to consider the purchase consideration, which is already computed, and the NCI also already computed. And you're going to get the goodwill as a balancing figure. Otherwise, you've already made the calculations as well. This is the entry which you already know. Now, my focus is that there is now going to be a discharge of this consideration. So I want to also tell you the entry which you're going to pass for discharge of the PC. So this is like the acquisition entry, and then you've got a discharge of the purchase consideration. So let's give you a consolidated entry for the discharge. The PC gets a debit. You might have paid the PC in cash. You might have paid the PC in equity shares issued at a premium. So this is the basic part. So you might have paid the PC in cash or equity shares issued at a premium. Then the PC could be in terms of DC, CC. So you need to also record the DC as well as the CC. So remember the fourth point which we did, that is you've got the DC, you've got a CCS, not CCE, then TC is gone. And then there could be, a case of share-based payments, which is already inserted in this PC. So you create an SBP reserve as well. So this is the deferred consideration, the contingent consideration, the share-based payments. And you've already made the reduction in pre-existing relationship. So you've taken care of DC, CCS, CCE, then TC, then share-based payment, and the previously held investments. Now remember one thing. When you take this PC, you can do another thing as well. At this stage, you can cancel the existing investment as well. That is the PHI. You're going to cancel that investment as well. So this PC includes the PHI, and at this stage, you can cancel the investment. So this is an important entry. That in this particular case, the PC is in shares and cash, then DC, CC, share-based payments, and the PHI, that is the cancellation of the previously held investment. This is all as far as the 7 steps on acquisition accounting is concerned. I've given you a comprehensive views on all these things. Now, what are we going to do next, friends, in the class is we've got reverse acquisition. That's 1. And we've got common control transaction. That is 2. And I would be doing a comprehensive question on the concept of acquisition accounting. I'll be basically doing a comprehensive question on reverse acquisition, then on the common control, and depending on the time frame, we're going to do at least 1 question on acquisition accounting so that the standard Ind AS 103 gets over. So that's what we're going to do in the next class. That is on Tuesday. So I would advise, please do a consolidated revisions of all the 4 classes we have done so far. So that once we do a little practice on Tuesday, you are very, very comfortable on the same. Okay, I think Shankara tells me, so today's class was Jingalala, sir. That's great. Thank you so much indeed. Okay, I guess, okay, if you got any questions, friends, you can ask me. Otherwise, I think let's call it a day. So that was quite technical indeed. So do enjoy your Sunday, but do your revisions as well. And try to do that question on RTP November 19, just in case if you can do that before the class. And thank you, Tanisha. Thank you so much. And thank you, Viraj. Thank you for clearing the concept. Thank you indeed. Thank you, all of you. So see you next class. Thank you. Bye-bye and take care.